Welcome back. Are you looking for some fantastic opportunities to buy dividend stocks, particularly looking at REITs? I have an absolutely cracker option for you today. We'll get into it. We're going to look at some of the benefits here, some of the long-term investment opportunities, and if you stick with me to the end, I'm also going to be looking at a very low-risk way of getting involved with this stock. Let's get into it now then. All right, so Agree Realty. Now, as you can see here, this is the April 2023 investor presentation. We can get a sense here for the type of organizations that they are providing the real estate options to. These are big names. If you don't come from the US, you probably still recognize most of them. Now, when you begin to think about what this means, it means that the people who are paying for the space that Agree Realty provides, these people, these companies, they're not going away anytime soon. Now, founded about 5 decades ago, they have been providing a very consistent benefit here for investors, and one of the key things here as well is also getting an investment grade issuer on their bonds as well, which is really important to think about. Some of the recent highlights here, and I want to draw your attention to a couple of the major benefits here. They've got the ground lease portfolio, which is an important baseline for them as well. That represents about 1/8 of their overall base rents. They've got a relatively low level of debt to the recurring EBITDA as well, which is important. The cash dividend has been going up at a fairly consistent mid-single-digit pace here. So again, the most recent dividend increase has been 5.7%. We're going to get into the benefits here for dividend investors soon. Now, as I said, their tenants are not going away. You begin to look at the investment grade or the creditworthiness of these tenants, and we begin to get a sense that they are indeed big, large, well-run organizations that are not disappearing anytime soon. So 2/3 of their tenants, the retailers here, are investment grade. Some of them are sub-investment grade. These others are not rated, but are going to still be fairly good tenants for them. One of the things that I really have enjoyed looking at here is their increase in the investment activities. So they've actually made some pretty substantial purchases over the last decade, really. And this has been ramping up, particularly, I think, taking advantage of their financial strength and sturdiness during and after the pandemic. It's also important to note that they don't just sit on property. They actually have been focusing on getting rid of some of the assets that don't any longer really fit with where they want to be and where they're going. And so we can see here from this slide in the investor presentation that they've really focused on streamlining, removing some of the assets that no longer fit, and then cycling this capital back into assets that do represent a much better fit for them. And this is really, really important. They have a very strong, a very powerful balance sheet. And I want to just show a couple of quick slides here from the investor presentation that I think are really important to look at. Number one, we see here virtually no debt maturities until 2028. Now, what this means is that even if credit and interest rates went wild for the next several years, it's not going to have a material impact on Agree Realty. And that's really important as well. The overall capital markets track record, we can see here that they've got some unsecured debt, mostly common equity. There is some preferred equity, and this is something that we're going to look at next as well. And this is a beautiful chart. Essentially 6% 10-year compound annual growth rate in the monthly dividend. So there's a lot of benefits here. Monthly dividends are very powerful for us. Now, hopefully that's given us a little bit of oversight into what the company is, what it does, and why I fundamentally think that this is a really interesting opportunity at the moment. What I want to do now is I want to turn over to fast graphs, and I want to have a good look at what's going on in the company at this moment and why it represents some really interesting opportunities for us as dividend investors. Okay, now first off, I very, very often do enjoy looking at this general historical chart here to get a sense of how the organisation's doing. Now we can see here, obviously, post-global financial crisis, there were a few issues there. We can see in the white line here, there was a bit of a dividend cut going on. But basically, since about 2012, we've seen this absolutely beautiful generally steady increase here in the FFO, the funds from operations. Now I have here the FFO, which is essentially the same as the earnings for a REIT due to the differences in how sort of REITs operate and how they manage their costs. Now there's a couple of key points here that I want to look at. Number one, analysts. Do the analysts have a pretty good sense of what's going on with this organisation, and do they normally get it right? So we can see here when it comes to the funds from operation, looking at a 1 year forward estimate for the analysts, they get it right about 92% of the time, and the company beats their expectations about 8% of the time. 2 years forward, the analysts get it right 100% of the time. Now, obviously, this is a reasonably wide margin of error here as well, but it's also important to note that fundamentally, the company both provides good guidance and is operating in a fairly stable way, which is important, I think, for me as an investor. Now, historically, what does this look like? So I'm turning over here to the overall performance to get a sense of how the company's been doing. Now, one of the things, as I noted visually on the chart, is since 2012, I wanted to have a look at how they've been performing here in terms of these dividend increases. And we can see here strong single-digit increases. One of the beautiful things here as well on fast graphs is it gives us an overall annual compound growth rate here and compares it to an investment in the SPY, the S&P 500 ETF at the same time. Now we can see here that there has been an overall slightly higher compound growth rate. Now this is obviously going to be partly determined by the exact starting date, so here I've just got the full historical data available for ADC to make it a reasonable comparison, so I haven't sort of cherry-picked a date here to make them look good. The annualized rate of return, though, without the dividends is slightly lower than the S&P 500, which sort of, again, indicates and outlines the importance of the dividends here in terms of the total returns. In terms of the total returns, we would have seen the dividends here paying out over this period $24,000 on a $10,000 investment, compared to the S&P 500's $8,000. So overall, it looks like it hits my benchmark as a reasonable potential investment here. Now, for the forecasting, I'm going to switch over to the normal multiple. Over the last 5 years, they have had a price to FFO, sort of like the PE ratio of about 20 times. That's suggesting that it is a well-regarded company with reasonable growth rates expected and a strong balance sheet. And that's what I would expect to see is a PFFO ratio that's higher than 15 under those circumstances. Now, a couple of key points here. The dividend yield is relatively, it seems almost low at 4.4, and we can see here in the blue line this price to FFO and the normalized price of about 20 times. We can look at the analyst estimates down below. Now we can see that over the last 6 months these analyst estimates have been revised downwards, but only really a small fraction for both the 2023, 2024 and 2025 years. So that's really encouraging to see. Now if prices return to the price to FFO ratio and the analyst estimates for FFO ratio outcomes are correct, we might be seeing potentially till the end of 2025 a 43% rate of return, which represents an annualized rate of return of about 14%. Now, given that they have a very strong balance sheet, given that they're very successful, I think, in terms of that overall active management of the portfolio, I think this represents a really interesting opportunity for us. What's this, you say? That yield isn't high enough? That beautiful dividend increase year on year is not enough to satisfy you? Well, okay, so there are some other options here. We're going to have a quick look at the preferred shares. Now, I think this is an option that might excite many people. It gives us a lot more stability, a lot more security, and I think at the moment also some really interesting opportunities. So let's have a quick look at this, and I think this should excite many people. So look, I think we've got some really nice opportunities here with the preferred series from Agree Realty Corporation. Now this was issued at 4.25%. Now there's a couple of things to note about this. Number one, look, this is low. In fact, that's the lowest for any REIT that's been able to issue these preferred securities, I think. Very close to the lowest level. Now what this means is it's a testament to the strength. So essentially they're able to issue these preferred shares at a low interest rate, and investors are prepared to accept that because they see the security and the safety of investing in ADC. And so that's actually a sign of the strength of the organisation. Now, on the face of it, it seems low. It's lower than the common shares, which is what we would expect. Now, the really important point here to note as well is the yield currently, if you buy now today, it's actually sitting at 5.9% almost 6%. That's because the shares were issued at $25 and 4.25% on $25, but the value of the shares has decreased as inflation has increased and overall interest rates in the market have increased. The value of these shares has decreased accordingly. Now, over time, as inflation comes under control, as interest rates begin to decline a little bit here as inflation becomes under control, the value of these shares should increase. They should come back to about the $25 level. So this represents, if you buy now, I think some really nice long-term yields and the opportunity to benefit from capital gains as these preferred shares revalued as the market changes. So let me know what you think. Is this interesting to you? Is this a really good opportunity? Do you invest in preferred shares, or do you prefer common stock as your number one go-to? Let me know in the comments down below what you think.